On August 15, 1971, President Richard Nixon announced a temporary suspension of the dollar's convertibility into gold. That single decision, framed as an emergency measure to protect American economic interests, severed the last mechanical link between the world's reserve currency and any form of physical constraint. What was promised as temporary became permanent. What was sold as necessary became structural. And what began as a policy adjustment evolved into a quiet redefinition of money itself. Most people remember that moment, if they remember it at all, as a footnote in economic history. But what actually happened was the removal of a governor from a machine that had been designed to self-regulate. Once that governor was gone, the system no longer had an automatic brake. It had discretion instead, and discretion over time becomes permissiveness. The pattern that followed is not unique to the United States. It is a pattern that appears across centuries, across empires, across political systems. When a government gains the ability to expand its monetary base without immediate physical consequences, it uses that ability, not because leaders are malicious, but because the incentives all point in one direction. Spending wins elections. Austerity loses them. Debt can be rolled forward. Pain can be delayed. And the consequences, when they arrive, are blamed on external shocks, foreign actors, or prior administrations. This is not conjecture. It is observable in the Roman denarius, which began as nearly pure silver and ended as a coin with less than 5% silver content after centuries of gradual debasement. It is visible in the assignats of revolutionary France, a paper currency backed initially by confiscated church lands, which inflated into worthlessness within a decade as the government printed to fund its wars and social programs. It appears again in the Weimar Republic, where the German government, burdened by war reparations and political fragility, expanded the money supply until a loaf of bread cost billions of marks. Each of these episodes followed a similar sequence. First, there is a crisis that justifies extraordinary measures. Then those measures become normalized. Then the normalization creates new vulnerabilities. Then the vulnerabilities are addressed with more of the same policy that created them. And finally, the system reaches a point where confidence, not mathematics, becomes the only thing holding it together. Confidence is not a renewable resource. It accumulates slowly and evaporates quickly. And once it begins to evaporate, the mechanics of the system start to work in reverse. What holds true for ancient Rome and revolutionary France holds true today, with one critical difference. The scale is larger, the speed is faster, and the interconnectedness is deeper. When the United States moved off the gold standard, it did not do so in isolation. The entire global financial architecture was built around the dollar's stability. Trade invoices, central bank reserves, commodity pricing, debt instruments, all of it denominated in a currency that was no longer anchored to anything except the credibility of the issuing government. For decades, that credibility held. The United States had the largest economy, the deepest capital markets, the most powerful military, and a legal system that international investors trusted. These advantages created a premium. The world was willing to hold dollars at lower yields than fundamentals alone would justify because the dollar was not just a currency, it was a system. But systems age, and as they age, the assumptions that supported them begin to shift. The federal debt of the United States, as of early 2025, exceeds $38 trillion. That number alone is difficult to contextualize, but the rate of increase is more telling. In the span of 2 decades, the debt has more than quadrupled. Meanwhile, the interest expense on that debt has begun to consume a larger share of tax revenue, creating a feedback loop where borrowing is required not to fund new programs, but simply to service existing obligations. This is not a temporary imbalance. It is a structural condition. At the same time, the global demand for dollars is no longer unconditional. Central banks in China, Russia, and other nations have quietly reduced their holdings of U.S. treasuries over the past decade. They have not abandoned the dollar entirely, but they have diversified. And diversification in this context is a polite word for hedging. When a reserve asset is being hedged against, it is no longer performing the role it was designed to perform. The dollar index, which measures the value of the dollar against a basket of other major currencies, has spent years oscillating around key technical levels. And one of those levels, 96, has acted as a line of support that the market tested repeatedly without breaking, until recently. In late January 2025, the dollar index slipped below 96 intraday, and the reaction in precious metals markets was immediate. Gold, which had been consolidating near record highs, pushed higher. Silver, which had already been experiencing unusual volatility, spiked above $100 per ounce before pulling back sharply. These moves are not random. They are responses to a repricing of risk. When the dollar weakens, assets that are priced in dollars must adjust. But more importantly, when the dollar weakens for reasons that feel structural rather than cyclical, the adjustment is not just mathematical, it is psychological. Investors begin to question whether the assumptions they have relied on for decades are still valid, And that questioning, once it begins, does not stop at the border of financial markets. It spreads into corporate treasury decisions, into sovereign wealth fund allocations, into the savings behavior of ordinary people who may not follow markets closely, but who notice when their purchasing power erodes. The last time the dollar index fell from the mid-90s toward 90, gold did not drift. It climbed, silver did not wait, it surged, and the move was not a brief panic. It was a sustained repricing that lasted months, and in some cases, years. What makes this moment different from prior episodes of dollar weakness is not the mechanics. The mechanics are the same. What makes it different is the context. The world does not have an obvious alternative reserve currency waiting in the wings. The euro is a shared currency governing nations with divergent fiscal realities, and that divergence creates periodic stress that markets price accordingly. The British pound, despite the depth of London's financial markets, has experienced episodes of acute volatility that remind investors how quickly confidence can be lost. The Japanese yen is burdened by a debt-to-GDP ratio that exceeds 200%, and any normalization of interest rates in Japan sends shockwaves through global carry trades that have relied on Japanese yields remaining near zero. The Chinese renminbi is not freely convertible, and capital controls limit its use as a global reserve asset. This leaves the world in a position it has not been in for nearly a century. There is no clean exit from the dollar, but there is also no guarantee that the dollar will maintain its purchasing power. When there is no exit, capital does not disappear. It reallocates. And one of the oldest forms of reallocation is the shift into assets that do not require trust in any government or institution. Gold has served this role for thousands of years, not because it is magical, but because it is scarce, durable, and universally recognized. Silver has served a similar role, with the added characteristic that it is consumed in industrial processes at a rate that exceeds new supply, creating a structural tightness that gold does not face. The supply dynamics of silver are worth understanding in detail. Unlike gold, which is primarily held as a store of value and recycled at high rates, silver is used in electronics, solar panels, medical devices, and power infrastructure. Once it is embedded in a circuit board or a photovoltaic cell, it is often not economically recoverable. This means that above-ground inventories of silver, which can be drawn down during periods of high demand, do not replenish the way gold inventories do. And as global infrastructure build-out accelerates, particularly in energy and data sectors, the industrial demand for silver is not discretionary, it is structural. Data centers, which are proliferating to support artificial intelligence, cloud computing, and digital infrastructure, are among the most power-intensive structures ever built. Each facility requires transformers, cables, connectors, and backup systems, all of which contain silver. The electrification of transportation, the expansion of renewable energy grids, the upgrade of aging electrical infrastructure in developed economies, all of these trends increase the baseline demand for silver in ways that have nothing to do with its role as a monetary metal. When industrial demand and monetary demand converge, price discovery becomes erratic. Markets that are accustomed to gradual adjustments begin to experience gaps. Volatility increases, and participants who were positioned for stability find themselves on the wrong side of a move they did not anticipate. This is not speculation. It is what happened in previous cycles when silver moved from $20 to $50 in less than a year, then collapsed back to $30, then climbed again. The pattern is not smooth, but the direction over longer time frames has been unmistakable. The question that remains is whether the current move in precious metals is the beginning of a repricing or merely another short-term spike. And the answer depends on what happens next with the dollar. If the dollar index stabilizes above 96 and central bank policy remains relatively tight, metals may consolidate. But if the dollar continues to weaken, and if that weakness is accompanied by a shift in interest rate expectations, then the repricing is likely to continue. And if the dollar index falls below 90 and fails to recover, the conversation shifts entirely. A move into the high 80s would represent a level not seen since the early 2010s, a period when gold climbed toward $2,000 and silver briefly touched 50. A move into the 70s would represent a breakdown of confidence that extends beyond technical levels and into the realm of structural reassessment. It would not mean the end of the dollar, but it would mean the end of the dollar's unconditional premium. History suggests that when reserve currencies lose their premium, the transition is not instantaneous. It unfolds over years, sometimes decades. But the early stages are marked by denial, volatility, and the emergence of hedging behavior among investors who are unwilling to wait for consensus. The lesson from every prior episode of currency debasement is the same. The people who move early are dismissed as alarmists. The people who move late are dismissed as victims, and the people who move at the right time are dismissed as lucky. But luck, in this context, is just pattern recognition applied ahead of the crowd. The system is not broken by any single decision. It is strained by the accumulation of decisions that individually seem manageable but collectively become unsustainable, and when the strain becomes visible, the options narrow. Either the system reforms, which requires political will and economic pain, or the system adjusts through currency depreciation, which distributes the pain more quietly, but more broadly. The metals market is not predicting the future. It is pricing the present. And what it is pricing with increasing clarity is the possibility that the assumptions which supported the dollar's dominance for 50 years are no longer as solid as they once appeared,